Okay, so at the mention of gratuitous bureaucracy, half the people have left the room, so that's encouraging. What we want to do, MiFID is a huge directive, as we mentioned. It really does spread the diversity of financial services. On one side, I look at it and I'm reading rules around product governance and distribution, and the other spectrum, I'm reading rules around tick sizes and commodities. So what we want to do in this section is just have thoughts around some of the capital markets impacts, particularly around the changes. You've heard some of these phrases mentioned already, phrases like OTF, and we didn't get into the joys of systematic internalizers earlier, we will do here, and how these are going to impact investment managers, that's the point of this. And also around some of the liquidity aspects that was touched on in the disclosure, but particularly around fixed income, and then also some of the technological challenges. So, and also, sorry, I've missed out quants and high frequency and the impact on those types of managers as well. So I'm going to join the panel down there, but I'd like them just to, perhaps if Neil could start, just to introduce themselves, and then we'll get into the first question.
Hi, I'm Neil Robson. I'm Regulatory Compliance Partner at Katten Muchin. Been there 18 months, but before that I spent almost 5 years at Schulte, Roth & Zabel here in London.
Hi, good afternoon. I'm Joe Feerick. I'm Managing Director of a company called Millennium Europe Limited. We're a dealer, a market-making dealer in fixed income securities, particularly corporate bonds. Prior to that, I set up one of the electronic trading platforms that people are talking about in Europe, and prior to that, I worked for ABN, managing rates business.
Good afternoon, I'm Mark Croxon. I'm part of the Regulatory and Market Structure Strategy Group here at Bloomberg. Recently joined 5 months ago and have worked for 20-something years in the banking industry, most latterly looking at this regulatory space.
Well, thanks. I think also in 5 years of presenting, this is the first time we've actually had somebody from Bloomberg on the panel, so welcome. So if we could just go to the first question to deal with, which should come up on the screen any moment in time. This is really to deal with these execution opportunities that we were talking about. So one of the objectives of MiFID is to increase competition across financial markets, and do you expect this will move, and the case of move to on-market trading, will this provide investment managers with better execution opportunities, worse execution opportunities, or just more well-intentioned regulation? If you could vote now, please. Right, we'll have to answer cynics in the room, so perhaps we set the tone earlier with that, but not convinced that this is actually going to improve execution. So, Neil, there's a number of different happenings in terms of the markets. Just could you explain to us what the different options are going to be for firms around how they can provide execution to the investment management industry?
Sure. I mean, just sort of setting the scene, as the last panel alluded to, in fact, MiFID II is an update to the structures we already have in place, the trading venues that we've been used to for the best part of a decade now, basically. Actually, the directive itself in one of the recitals says that Brussels wants, as far as possible, to ensure that trading in financial instruments is carried out on organised venues and that such venues are appropriately regulated. So, we've got regulated markets, which I'll move on to in a second. We've got multilateral trading facilities. I think it was Leonard in the last panel was talking briefly about organised trading facilities as a new trading venue. And then there's the sort of poor orphan of MiFID I that really didn't quite have a home and didn't really work, which was the systematic internalizer. So these are the four sort of trading venues that are open to us in which MiFID II really tries to tie down more thoroughly so that it works better. Part of the rationale for this is the fact that the world has changed since MiFID I was first drafted. It came into effect in 2007, but was drafted and tied down in 2004, the actual directive itself. The world has moved on, technology has moved on in a big way. So that's why we're seeing these particular changes. So to step back to the two kind of key areas of MiFID I that have worked, the regulated market, which obviously has been in place for some time. These are your stock exchanges, effectively. Multilateral system operated or managed by a market operator, which brings together or facilitates the bringing together of multiple third-party buying and selling interests in financial instruments in the system in accordance with non-discretionary rules in a way that results in a contract with respect to the specific instrument admitted to trading on that market. So this is your core sort of equities trading venue. That's not really changing. They're quite happy, Brussels is quite happy that that works, frankly. There's some tweaks, obviously, as was discussed on the last panel, in terms of how trading takes place, the transparency itself, but the actual market itself is not really going to be changing. Same really goes to broad extent with the multilateral trading facility, which again is a multilateral system operated by an investment firm, significantly this time, or a market operator, which brings together multiple third-party buying and selling interests in that system, again, in accordance with non-discretionary rules, yet again. This time round, though, of course, the instruments don't have to be admitted to trading on that market. They're not listed instruments per se, but it's a more rigid trading venue subject to strict rules the way it operates. Prime example of that, of course, is BATS Chi-X, which has grown and developed markedly over the period of MiFID I being in existence. So moving on, though, in terms of the new trading venues, the OTF, the Organised Trading Facility, again, it's been phrased and sort of structured in a similar way in concept to the two venues I've just been talking about. Again, it's a multilateral system, but this time it's not either a regulated market or a multilateral trading facility. Again, it's somewhere where multiple third-party buying and selling interests can interact. But this time round, significantly, it's focused on bonds, structured finance products, emissions allowances, and the derivatives thereof. But they interact in that system, but significantly, this time round, though, the big distinction here is it is a discretionary type of market, trading venue. So the operator of the market will be an investment firm, and it can basically pick and choose who it wishes to trade with, which is obviously very different than someone like the London Stock Exchange. The idea really here is it's supposed to sort of plug the gap, because the multilateral trading facility, I think when MiFID I came in, people thought it would be more broad in concept and would capture more trading. Obviously it didn't, and the idea of the OTF is to pick up the fixed income markets effectively, so that it's more rigidity to the structure of how these trades take place. OTF operators can participate in matched principal trading in the bonds, etc., that I've just referenced. So there's more flexibility to the market than obviously to someone like the London Stock Exchange. But again, you've got the whole issue of the transaction reporting, all the topics that were covered on the last panel. So it's another more traditional sort of rigid market structure, which is being pinned down by MiFID II. But because of that discretionary element, one thing that's rather different is, certainly unlike a multilateral trading facility operator, is that because there's discretion, a lot of the rules on things like best execution, suitability, client order handling, all of these rules in MiFID II, which are obviously being upgraded, they will be relevant to trading on an OTF. So for you guys as fund managers, certainly your trades on an OTF perhaps is going to be better, certainly more clarity for you than trading would have been on an OTC basis in years past. And talking OTC, obviously it's not being prohibited under MiFID II at all, but actually the systematic internalizer concept, which really didn't work under MiFID I, that's where sort of your OTC type of trading activity will take place. When I say systematic internalizer didn't really work under MiFID I, when it came in, there was a lot of discussion, a lot of debate. People thought there were going to be hundreds of systematic internalizers registering. You register with your national regulator, and then there's a central registry held by ESMA. As at this morning's date, I did have a quick check. It's not changed for many months. It's still only 11 systematic internalizers registered, of which 7 are here in the UK, and they include Citigroup, Goldman's, UBS, and Credit Suisse. So, in terms of a change, this is going to be quite a significant one. A systematic internalizer is an investment firm which on an organised, frequent, and systematic basis deals on its own account, executing client orders outside of an MTF, an OTF, or a regulated market. So this is the OTC trading, effectively. Now, it's quite significant, really, in some ways, because they're not changing the definition per se, other than to add the OTF point. But what they're doing now, MiFID II is saying, OK, because the concept of are you trading on a systematic basis was so woolly under MiFID I, they're going to pin down specific quantitative thresholds so that each firm will have to assess on a quarterly basis, on a quarterly rolling basis, have you met the two thresholds? So the first one is for the frequent and systematic basis. It's going to be measured by the number of OTC trades carried out by the firm in a specific investment by executing its own client orders. And then the substantial basis is going to be measured either by the size of the firm OTC trading overall with regard to a particular instrument vis-à-vis the whole market, or by the size of the firm's trading compared to anybody else's trading in that particular instrument across the other markets. By way of example, for example, for a liquid bond, the guidance at the moment is saying that 1 trade per week over the course of a year would be likely to push you into the systematic internalizer requirement, the registration requirement. The idea is that it's supposed to be defining exactly how these trades take place in an OTC environment so that there's more transparency, so that the price formation process on the O2C world isn't prejudicing the way that prices form in regulated markets and so on. So it's supposed to really be bringing off-market trading, your dark pools, your broker crossing networks, into the light. In fact, there was an article on Bloomberg just last week I saw that Brussels is still very concerned that dark pool trading is increasing literally year on year, notwithstanding the fact that we've been discussing MiFID II for years now. And the idea is that obviously Brussels wants this to reduce so that the trading goes onto lit venues. But if the number of trades is increasing, I mean, last year I think they were saying it was almost 10% of the whole of the European market. You know, this is something that the authorities in Brussels are trying to sort of push down on.
And when we talk about these things, OTFs, MTFs, systematic internalizers, there's a lot of jargon being found. What sort of firms will actually, it's a question I've had come in from the audience, what sort of firms will actually be caught by this? You mentioned some names. Is it always only the large houses, or will matched principal brokers or proprietary traders be caught by some of these?
I think matched principal brokers are more likely to be an OTF. They're an organised trading facility in the sense that they're facilitating trades between two parties. They don't take the trade onto their own book, generally. So they're more like sort of, an exchange, in inverted commas. They're an organised trading facility. So they're not going to be a systematic internalizer. But yes, as you say, sort of proprietary traders, I mean, they're much more likely to be, because they're an investment firm trading proprietary capital. So they're more likely to be caught by these rules. So I think we're going to see a lot of those types of firms registering as systematic internalizers. Potentially some brokers themselves could be caught, though, yes.
Okay. And the other question that's came in, these brokers, I mean, match principle, if I think of capital adequacy rules, it's one of the simplest regimes out there. It's viewed they're not taking risk. Yet they're going to be subject in terms of review by the regulator of their trading activity to ensure that they are matching the trades. And then these firms that are proprietary are then going to have to be called by authorization and get themselves authorized. The question again from the audience, is that going to actually reduce liquidity, i.e. firms are just not going to bother with the detailed regulation and withdraw their capital from the market?
Interesting question. I suppose potentially, some of the smaller shops might find that the cost of compliance is enough to make them question whether or not they want to be registering as a systematic internalizer, etc. I suppose to do that, they're going to have to monitor all their trading activity to make sure they don't cross both of those two thresholds. Because as soon as you do cross it, you've got to register with your local regulator. So whether or not they provide liquidity to a point and then just cease trading and say, sorry, no, we can't provide liquidity for that trade, you've got to wait for next month when we might be able to start afresh. I think certainly the big shops is going to stay in play, definitely. Katten acts for quite a lot of proprietary trading firms. Our Chicago office is quite well known for it. And I'm seeing quite a lot of interest coming through from them in terms of, we want to keep providing liquidity to the markets in Europe. Looks like we're going to have to open an office in London. It's going to keep me busy for the next couple of years by the sound of things. But, I don't think there's going to be a marked drop in the amount of liquidity on the markets. I think it's simply people are becoming more accustomed to more reporting, more regulatory obligations.
Okay, so if we then move on to an aspect we did discuss touched on earlier around disclosure, because obviously there's going to be market changes, and then the other change that's happening is really around disclosure. So we had a polling question, if we could go to that now on the screen, before we lead into Joe, which was around greater pre- and post-trade transparency, requirements for fixed income. Do you consider that the transparency is going to be a positive market development? Do you strongly agree, neither you sit on the fence in the middle, disagree, or strongly disagree? So is this going to be a positive development or not for the industry? Could you vote now, please? Okay, so I think probably that's telling us broad agreement to the idea of greater disclosure. I think that's pointing in that direction. Joe, do you want to just give some background as to what this drive for greater disclosure is, contrary to the move towards the dark pools that Neil's been referencing?
Well, I have to say I'm kind of pleased with that result. I'm somewhat relieved because I kind of expected, if you follow the discourse in the media, you would expect a lot of people to be in the bottom half of that answer set. So it's quite good news to hear that industry representatives in general think that pre-trade transparency and post-trade transparency is a good thing. I apologise up front. My worldview is fixed income and specifically corporate bonds. And one of the things in facing my job over the last 10, 15 years is everyone saying that there is no transparency in the markets. But actually, I think there is. There's a lot of transparency. And actually, quite a lot of what MiFID II appears to be trying to do is classify or bring some meaning to what that transparency is and where it is. And actually, again, disclosing a self-interest, us as a dealer, we rely on transparency. In fact, our market model wouldn't exist 10, 15 years ago. And in the US, where we've been going for some time, we specifically found it on the basis of the post-trace environment. So we very much welcome it. What is happening with pre-trade transparency is obviously more formalization around the process, more definition as to what it means. We talked a little bit, Neil talked a little bit about MTFs and OTFs, what they are. MTFs have been around in fixed income for some time. I ran one for a number of years, delivering pre-trade pricing in corporate bonds to the markets. I think the issue for the buy side has been that where they see that pre-trade transparency, they don't trust it. And that comes down to the difference between a firm level or an indicative level. And only the post-trade transparency will give you absolute truth in the pricing, which is why that's so important. In terms of what the MTFs and OTFs are having to do in the new environment, it's actually not that much different to what's going on today in terms of redistributing and displaying the pricing out to end users. In terms of post-trade, it is true that too much disclosure in big-sized trades and so on can move pricing against participants, can damage the market, hence liquidity thresholds and so on. But what we've seen in the US, where this post-trade paradigm has been around a little bit longer, is a tendency for trade sizes to reduce, a tendency for more trades to be done electronically. And actually, what has transpired is actually an increase in the number of participants in the market and the amount of volume that's traded and the instruments that are traded upon. So there's a lot of body of argument for and against the benefits of trace in the US, but certainly us as participants have seen a massive improvement from our point of view. Also, I don't know whether it's been discussed already today, but other changes in the regulatory environment are forcing dealers to pull back a little bit on their traditional market-making activities. We touched upon whether participants will pull back from market making because of the over regime, if you like, the compliance that's coming in. I think balance sheet constraints and dealers having to park their capital where they can make most money is probably the biggest threat to liquidity provision in bond trading, at least. But one of the good things about the new paradigm is that new participants like ourselves, who can overcome these compliance constraints, can actually participate in markets that previously we couldn't. And we can actually, to an extent, fill the gap that's been left by the larger, more traditional players. So overall, pleased to see that result. I think it does reflect, the general mood as I intersect with the buy side. One thing I do see, I think it was touched upon in the last panel, is this debate about when the regulation is going to come in and when people have to be ready by. I do see pre-adoption amongst the buy side. There are people already using tools that have been set up to kind of benefit from the new information that will be available. And also there's been a transference of skill set from the sell side as they pull back on their activities to the buy side. So there are particularly larger investors, admittedly, who have specialized dealing desks with people that have come from the sell side who are better able to understand where the valuation of the pricing works and where it doesn't, and are dealing much more with best execution in mind. And we see, for example, a lot of order flow from clients who are using smart order routers to analyze where the market price is, analyze where the best execution venue is, and route their order accordingly. This is activity that they didn't do in bond markets 10, 15 years ago. So I think those people who are already doing that are obviously best placed to really benefit from the information that will increasingly be available post MiFID II.
So it is already having an impact on how fund managers operate or organise their execution arrangements. And is that a fillip again to those larger fund managers, and perhaps smaller managers of scale may not have the investment opportunities in such systems to respond?
I believe so. One of the problems that regulators have had, of course, drafting these rules is that we talk about it as though it's one market, and of course it's a market of markets. Regionally, we could get into a number of differences, but probably the main one is size, block trading versus retail trading, wholesale versus retail. A client who has 100,000 order to execute does not have a problem getting a price for that trade they're trying to do, does not have a shortage of options available to them. And arguably, liquidity in that is very good. Now, again, you could say, well, what if it's a very illiquid bond? Yes, that is true, and more activity does seem to be focusing on more liquid instruments. However, if you're trying to do a 10 or 20 million block or sell a large position when the market is widening massively, as we've seen recently with energy blowouts, etc., then clearly you're going to struggle to get that trade done favorably. And I think a lot of people will then comment that liquidity is really bad. But actually what they're trying to do is a bad trade. And no dealer is going to sit on the wrong side of a bad trade in the current climate, especially with the capital constraints that they're now under. So I think what you'll see, and what we've seen in the US, is how many years have to go by before execution desks think, well, maybe I shouldn't get into a 10 million position on a liquid bond on the way in. That maybe we should think about spreading our investments wider across more liquid instruments where liquidity risk and the liquidity premium is less, and that the execution on the way out is much easier. And that's what we see already. I have very large buy-side clients who you would think trade only 5, 10, 20 million blocks in credit, but they're coming through every day with 50, 100, 250 orders. And they might manage down a position over a period of weeks rather than trying to get the 10 million done in one day. Those people don't complain about liquidity. They just quietly get on with it. So not everyone, obviously, business is the same. Obviously, the larger investors that have larger aggregated order flows from their end retail networks can run the numbers over the execution and place their orders accordingly. And people who are smaller, who probably only have less executions to do, and maybe not all, they can't choose when. Obviously, it's tougher for them. But over time, what I see is people evolving to trade in a way that's consistent with where the best execution is.
So are these kind of fears and concerns then a bit overblown by the commentators around these changes, perhaps driving a lack of liquidity or pre-trade transparency? People won't be prepared to put quotes out there because of the risk of being held to the trade. Are you saying that actually the markets are evolving anyway, and this is all travelling in a consistent direction, and we're probably making those prophets of doom are probably fated?
Well, I am limited by my worldview, as I said earlier. I don't want to underplay the difficulties associated in other asset classes and large-scale trading in derivatives, for example. I leave it to others. Particularly, it's difficult for me to comment on competitors who are larger dealers pulling back in market making when others are coming into the market and participating more. It does seem to be, for every commentator that's against what's changing, there are those out there who are for it. So I don't want to underplay the difficulties, but I think the market has an incredible capacity to evolve. I remember sitting on a panel 2 years ago talking about T2 and everybody panicking and the world's going to end, and that's largely come in with barely a murmur. And I think to an extent there'll be a similar experience with MiFID II. I think there will be an element of people just getting on with it. Where I wouldn't want to be is perhaps on the side of the commentators that look like they're protecting vested interests from the previous regime. History is not on their side. History is on the side of more trades in smaller sizes and greater transparency. The last panel talked a little bit about unbundling, and that was very interesting to me because we're a dealer that doesn't do any research. We focus on productivity, lean cost structure. Everything goes into our price. And I'm not saying that unbundling is about stripping away, hidden costs, if you will. But for example, I'd like to be able to offer a buy-side investor a price that's purely based on my view on where the market is at that moment. And I'm not considering any other aspects about whether, I've provided research that I want to get a return for. So I think, again, we've seen this in the US and in other large segments like, rates trading and derivatives trading. You've seen participants that 20 years ago had no involvement in fixed income, and they are now top 10 dealers. And I think you'll see the same post-MiFID, a flattening of the environment, healthy competition amongst market-making providers, and that should ultimately feed through to better execution for the buy side.
And suggesting that actually we end up with perhaps boutiques of specialists in research, specialists in dealing, and specialists in managing, and only the larger houses might have some combination of all three.
Absolutely. And again, this is not for every buy side, but the larger buy sides I see, as I mentioned earlier, they can navigate between execution, venue, and dealer, trade by trade, inquiry by inquiry. The tools they have, fairly sophisticated, but there's going to be a number of providers, I think there's one sitting to my left, who will be able to answer the need, provide those solutions at a reasonable cost. And people, again, we touched a little bit on best execution policies in the last panel and what those mean. Effectively, a best execution policy is whatever the buy-side participant thinks it should be. But there's no better way to demonstrate best execution by showing that you're throwing the net widely, you're assessing multiple liquidity sources, that you are able to change fairly quickly. I still, in my job, the biggest thing is getting new accounts opened. I think I've managed to get 150 open in the last 6 months. I think globally we trade with about 700, but I still contend with buy-side institutions that want a broker list of 10 dealers because they claim that to have more than that costs them more money in administrative overhead. Now, of the other 90 or so participants they could be sending their orders to, how do they know that on net they're not going to achieve better execution over a long period? And I would say that those that are able to assess multiple liquidity sources quickly effectively prove their own best execution by testing the sources that are available very quickly.
I've got a question here. Looking around the room, I can guess who it's come from. But it's actually dealing with ETFs, so it's a bit unfair. But I think the point here is around, it's two ETFs in the same broad market index, one priced around 1,000 and another 10, so I assume it's priced around 10. So putting in a great disparity on prices. And are we being gamed here, or will MiFID help us? So is it the case that MiFID will require a closer pricing of different products on these different exchanges, so that there's a closer visibility of pricing? Is that the expectation?
Yeah, I mean, ETFs is a whole topic, and we could go there. That's very interesting. That's something we get involved with. But the problem with forcing executable prices pre-trade is that, I mean, you see it today. There are MTFs and regulated markets where, for example, you can price corporate bonds on an order-driven exchange basis. You can put matching orders in or hope to match orders. There's a couple of platforms that have mandated market making. You have to make live prices between certain times and a certain number of instruments. When you look at the pricing that comes out, clearly it's not representative of where the execution is going to occur. If a forced market maker is long a bond, they're not going to put, and they want to sell it, their mandated pre-trade executable price is going to represent their willingness or not to trade. And so the reason, I was saying earlier that I think it works okay at the moment is that with indicative pricing, a dealer can afford to say, well, look, I may or may not be here, but this is where I honestly think the best price is at the moment. If you want a firm price, come to me with your size and quantity, and better still, if I know who you are, I'll give you a firm price. If you force me to make a live price in an anonymous market, and I don't know what size potentially that I'm being asked to trade or which direction, naturally I'm going to put a very defensive level out there. So I think the danger of this forced pre-trade transparency is it will not be indicative. However, and I will say this, if you have a good post-trade regime working and you can combine the two information sources, I think that's a very powerful combination. And certainly us as a dealer will be looking at pre-trade information, marrying it up with post-trade executions, and seeing what the difference is between the two, because that's very, very instructive to our ongoing market making.
And there's an interesting point on the post-trade execution is that you are supposed to be making publicly available to your commercially similar clients from the dealer side. Now, there is some guidance still required as to what commercially similar clients means and how much you can tier your clients and so on. But there is a risk that if you're holding yourself out to 5 more clients than just that one execution, you're going to potentially reduce the size of transaction that you're holding out as a firm price. Now, to counter that, to give some balance, in the States, we've seen the CEF, the implementation of CEFs there, and we haven't seen the thing that we were talking about 2-3 years ago, which was the potential for futurization of derivatives, for example. Much, much smaller clips, much, much higher frequency trading, which could go down the route of algorithmic trading and so on. So I think there's if you look to the US as an example of something that is similar, and you look at where we're trying to get some clarity on what commercially similar means and whether that's a post-trade indication rather than an actionable price, then I think we can mitigate some of those potentially liquidity damaging things that we might see.
Well, there's another interesting observation on this, which is speed of execution that we haven't really touched on, I haven't heard today. Quite often we'll receive an inquiry from a client in 50 bonds and they'll put it out to 20 dealers. That inquiry will trade within 10 seconds. So they've received sufficient pricing in 10 seconds that they're happy to execute. What value is the pre-trade pricing to the market in that situation? Admittedly, there's a trade-off when you get to larger sizes, but what we have seen in the US, where an all protocol is more common, is that buy-sides who send to 40 dealers are confident enough now that they'll get enough prices to execute in a short enough time that they're not going to get front-run. And they're not going to be left with an order if they don't execute first time around. And so, again, we talk about the need for pre-trade execution, and it's good. But in terms of actually how it impacts execution, I'm not convinced. I think for those who want to digest that information and use it, I think it's very valuable. But this worry about how it blows up trading at the point of trade, I'm not convinced.
I want to pick up on some of the uses of technology with you, Mark, in a moment. But just to go to the next polling question, because I think quantum we mentioned a couple of times, and obviously technology speed trading, very relevant to high frequency and quantity trading, and they're quite impacted by this regulation. I know it's a niche area, but it seems like a lot of controls have been placed on that as a sector. So just to move on to the next polling question, this is really picking up on some of the stability aspects of MiFID. So another objective of MiFID II is market stability, leading to more regulation of algorithmic and high-frequency trading. So in your view, is this about time regulation is catching up with technology, constraint on entrepreneurial spirit and an affront to free markets? It's all Michael Lewis's fault, or a sensible and balanced regulation in an area of systemic importance? So there we go. If you vote now, please. Right, so I think probably that's showing us those similar questions. It's showing us there's a strong skew in the room towards, this is sensible regulation and regulation catching up with technology. So, Neil, can you just sort of briefly just outline how those providers of services will be impacted, particularly perhaps some of the funds that are managing those strategies, and whether they are going to have to become separately regulated?
Yeah. I'm pleased to see that up there, because obviously MiFID II, in part, as I said earlier, is about updating regulation so that it's caught up with technology. Algorithmic trading, yes, it did lead to the flash crash of May 2010, and the reference there to Michael Lewis and his Flash Boys. When you feed that into the whole process of the MiFID review and the statement in Flash Boys that high-frequency traders were front-running pretty much every trade in the States. It's focused on the States, but presumably the reference is, it could have been anywhere in the world. You're using an algorithm, you're feeding in all that data that you were talking about before. You've got a computer program that, is many, many thousands or millions of times more complicated than the programs that NASA used to send rockets to the moon. Technology has moved on enormously. So the whole concept of algorithmic trading, yes, there are prop trading firms who use algorithms, but I've got a bunch of clients who are quant firms. Quantitative traders use algorithms to determine what trades they're making. So the MiFID II review has drawn this whole area of the market into scope. So, for example, there were some firms who, certainly in the prop trading world, were exempt under MiFID I. Yes, they used an algorithm, but because they weren't market makers, they were trading their own money, they were able to be unregulated. Under MiFID II, they've got to become regulated. The world is changing for, the number of exclusions and exemptions available is much, much smaller. A quant firm, one assumes, is either already going to be a MiFID firm in the UK already, if it's sub-advisor to an offshore AFM, or they're already going to be an AFM themselves. But what's interesting under MiFID II is simply the reference to use of an algorithm to trade is something you have to report. Indeed, you may need to be registered or regulated to be using it. Transaction reporting, when you report your trades, you have to say who the trader was. But if it's an algorithm, you have to report that it was your algorithm. The idea is, in theory, that once you've got enough data in the system, a regulator can say, there's a blip in the markets or whatever. It was caused by that algo going haywire. Algorithmic trading firms, whether they're prop traders or quant firms, there's a whole bunch of regulations. I won't go into too much detail, but if you use an algorithm, you've got to have have the ability to pull the plug at any given moment, and that plug also should be available to the compliance function so that they can pull the plug. There's a requirement that the compliance officer of the firm understands how the algo works. I have no idea how these things work personally. Techie people are, not necessarily the same as compliance officers and, general counsel in a firm. But the fact is, if you're the compliance officer with the kill switch, you need to have access to the folk who wrote the algorithm so that you understand it at all times. This is what MiFID II and the regulation and the regulated technical standards that sit under it all of these requirements are in place. MiFID II is going to be a massive change if you're this type of firm. Yes, it's a small sector of the market, but it's a significant sector given the volume of trading. Some of these firms trade on a microsecond basis. Co-location facilities is one of the indicators of a high-frequency algorithmic trader. The fact that you're 100 yards closer to the stock exchange, your servers are in that building, not the building on the other side of the street. That nanosecond is enough for your trades to make you make a profit. This is a whole new world order and a whole world of regulation that a sector of the market's waking up to. Just to give you some examples, a high-frequency algorithmic trading technique, which is specifically the piece that's going to be regulated. We don't know if it's going to be a regulated activity yet or if it's just a notification. That aspect is still to be confirmed, but it's got to include at least one of the following facilities for algorithmic order entry: co-location, proximity hosting, or high-speed direct electronic access. That's also being regulated. Service providers that provide you with a route into the market, they are going to have to be more thoroughly regulated themselves. They're going to have to vet you and do more due diligence. They're going to have to effectively supervise your activities, your trading activities, because you're using their code. It's a little bit like the appointed representative and principal relationship. You've got to put a contract in place, which effectively the FCA is going to be able to have oversight of. They're going to be supervising everything. They're taking on more risk for you. So I would question whether or not, in fact, there may even be a higher cost as a result. But I mean, the key part of algorithmic trading is, it's system determination of order initiation, generation, routing, or execution without human intervention. So to the extent you do have human intervention in your trading activities, then you're probably not necessarily in scope of this. But as I say, it's a significant change for the markets if you're in that sector. And obviously, your counterparties to a lot of trades, market makers themselves, are probably high-frequency algorithmic trading firms. So they're now going to be regulated, whereas today they may not be. They may be in effectively the unlit side of the markets. So big changes.
Things like smart order routing systems and so on, direct access, they get caught up in this. So though we talk quantitative funds, managers that use those techniques, perhaps provided them by the brokers, they get caught potentially by these rules too.
That's right. I mean, there are some exemptions which are sort of taken out of scope. For example, a system that is only used for the purpose of routing orders to a trading venue is not itself within scope here. But of course, that's pretty narrow if it's what it's only used for. So a smart order routing system, yes, it may be out of scope, but if there's any bells and whistles attached to it, that may be dragged into the scope of being regulated and need authorization. Okay,
so I think it's probably a good point moving on to technologies. We're starting to talk about as a provider of some of these applications. So the second to last penultimate polling question, we just have that on the screen. This is just getting to sort of how much we think this is when it's going to be affected. So where will MiFID II impact your firm the most? And I'm just going to ask you to pick one. Is it senior management board level, front office, technology, compliance, marketing and distribution, or operations? So if you could vote now, just one, please. Of course, the hostage of the fortune was that technology didn't come out top having that level. We're talking about some compliance. So let's actually, perhaps, Mark, you just pick up the compliance technology issues, and then that kind of wraps up the two middle ones. And obviously, I think it's going to be ops sort of using those.
It doesn't surprise me really that compliance and operations come out as the most effective, because ultimately those are the groups of people who have jobs to do to monitor and make sure that a firm is compliant. And technology, yes, there are people who build and implement and maintain technology, but technology is going to have to be implemented to help the compliance folk and the operations folk do their jobs. I think there are a number of areas where technology needs to be implemented. First of all, you've got the data collection. So if we look at, in the fixed income bond market, for example, the liquidity of instruments. in the RTS that were published, we're going down broadly this IBIA, instrument by instrument approach. So rather than just having a small number of tens of classifications of instruments, you've now got thousands of instruments that are going to be deemed liquid or not, and are going to be periodically assessed. So there's data to be collected on that. And then there's the working it through the rules engine of, am I a systematic internalizer? Am I likely to change my categorization as a systemic internalizer? And looking at the trade sizes, looking at the waivers and deferrals in respect of the large in scale and the size specific to instrument, the size of the trade, broadly speaking. Then from the transparency perspective, both pre and post trade, there is that rules engine to overlay it, which has to be real time. We're talking about the pre-trade conversations that go on around price discovery, and we're talking about immediately making your executed prices publicly transparent. So there's an element of the rules engine there, which a lot of us have started to deal with transaction reporting, which is typically your T+1 reporting to your regulator, your national competent authority, but it's much more real time. There is obviously then the technological challenge of all the pipes and plumbing, which is plugging it in here, and we're seeing formats being developed and changed, and inevitably when you get new standards and requirements, new vendors come along, new standards come along, new fields get added occasionally when you go through the review of these. But broadly, you've got to establish and maintain the pipes and plumbing, if you like. Similarly, we talked a little bit about the algorithmic trading or the electronic trading. You made the comment that we might see a move to more electronic trading. Well, you've got the connections to those trading venues, to either to singular trading venues or the hubs that bring together some of those trading venues. And of course, don't forget, we've moved on from EMIR, but the EMIR clearing obligations are coming into force this year finally, and so you have the connections to not only to the clearing venues and to your clearing brokers, but also potentially all the limit checking hubs that are out there that will be linked up. We're not quite at the point yet of getting the certainty of clearing at the point of execution. The trading and the clearing elements are somewhat separated still. We can move on to the record keeping. We talked about the whole process flow of the conversation about price discovery through the execution, and I guess subsequently, into some of the corporate actions potentially having to be recorded. We talked a little bit about the granularity of the time stamping. So high frequency trading is down at the microsecond capability. Voice trading is much more manageable at the second, but even so, you have to synchronize your clocks so that we're all talking about the same reference point, and we can order all of the events that are going on in the market. And how are you going to store all of that information? There's a term, WORM, another acronym that's come out there. Write once, read many times. And one of the panelists on the previous section said about the obligation to store that data for up to 7 years. What's the purpose of storing it if you're not going to be able to reconstruct your trades? Any number of reasons why you might do that: for your own surveillance reasons, for investigations, either about activity that your firm's been involved in, or generally one can assume that the regulators might be finding their own investigations about what was going on at similar venues, similar firms, similar products at that time. So there are requests for you to be able to retrieve that data in relatively short order. Again, the amount of trading that goes on, this is not. We've moved on from sending a porter down to a warehouse in Slough to find out a dusty archive box and flick through it. And that process can take 2 weeks at least. It's much more real time for you to be able to reconstruct that. the compliance folks, one of the jobs they've got, not specifically just around MiFID and MiFIR, or MiFID II and MiFIR, but of course the Market Abuse Directive and regulations which come into play in July this year. How are you going to monitor your firm's activity and look for unusual transactions? Just broadly calling them unusual. Makes sense to to have some form of systematic way of highlighting the exceptional ones, or the ones that might raise a flag that you might want to have a look at, and certainly to look at random sampling, on a retrospective viewing perspective. We've talked a little bit about best execution. Best execution under MiFID used the phrase all reasonable efforts, or something. It's certainly all reasonable was the key term. And one of the key phrases under MiFID II is all sufficient. So broadly speaking, your obligations on best execution are much greater. And you've got three elements to that. What's your policy? How do you select your trading venues? How do you select your brokers? You have to quantify your performance against that policy. And you have to make, broadly speaking, annual reports about your performance in those areas. And again, for some of you who are not, trading huge amounts of volume of transactions every day, that may be something that you can do relatively simply, on a spreadsheet. But for those of you that are much more trading much more frequently and have a higher volume of transactions, some sort of technological solution to that is obviously going to be much easier. And not only then does that, it's a bit like you don't get the January the 31st sort of panic of getting your tax return in, and writing your report about your best X to your clients. If you have something systematic, you do have the potential for looking at the way, at making action to bring you back into line if you see things slipping away from your policy. The final area that I think, again, was touched upon in the previous panel was around research. For those who are consuming research, in general, regardless of where we come out in the regulation about unbundling or explicitly paying for research, we're all now consuming lots and lots of data throughout our lives. And I think in general, social media and distribution networks make it so easy to distribute research out to people. I wonder how much research that is distributed to you and your firms is actually consumed, and of that is consumed, how much you actually think is material and useful. So some way of evaluating the research, looking at the research that's been consumed by your firm, and then evaluating that research, or filtering the research to overlay it with your portfolios or investment instruments. Technology can provide solutions for that. At the end of the day, though, all of these ways that you cope with these requirements are going to come down to, in some respects, the cost, the time that you've got, the resources you've got available to implement those solutions, and of course you've got to balance that up with your regulatory liability. How much, how accurately you need to report on some of these, and where the line is between doing a reasonable job that meets the requirements and doing a very exact job that may be a competitive differentiator. And I think that one of the questions that a lot of firms will ask, certainly those firms who are smaller than the large investment banks, the larger asset managers, is which of these solutions confers a commercial or a competitive advantage, and use that sort of thinking to determine whether or not you build it yourselves or whether you outsource it to either third-party vendors of systems or to third-party providers of services.
Let's just very quickly pick up on, I think, Reggie's point this morning in the governance session. She says, I want all my staff to be compliance people. Joe, does the technology opportunities actually put you as a dealer at the front of the compliance responsibility because of all of the information that you're going to have, and actually it's going to be very hard for firms to stitch together at the back end for compliance to see? So does it come down to, does the compliance come back to you at the end of the day?
Definitely. I mean, when my firm was going through its authorization process, the FCA focused pretty much entirely on our CISC, how we manage our risk, how we manage our balance sheet, how we ensure we have sufficient capital to underpin our positions. And if I couldn't talk through how that worked at a fairly granular level, I think that it would have been a much tougher process. And I think the modern market maker does something very differently to traditional large dealers, which is you price in the effective cost of risk and capital before you price up any order inquiry. I know how much that trade is going to cost me in those terms before I do it, whereas large and traditional dealers would think about that as perhaps a little bit of an afterthought. Clearly, they have more resources to deploy than a smaller dealer, but nonetheless, I think that thinking is definitely going to be transcribed into the processes of the smaller dealer in the future.
So compliance is going to start at the front. So
Absolutely.
I think that's the time. So thank you very much for your questions that came through. Thank you very much to the panellists. Tea and coffee is now available outside.
Thank you.